corny, right?
Like 80s,
Like
Maury Povich music.
Maury Povich music?
Sally Jesse Raphael music.
I'm waiting for Green Day to jump in.
Green Day to jump in.
It's kind of 90s.
It's got a little
That's
bit
what
of
I
a
mean.
beat
It's
to it.
90s. Feels talk showy, but
Yeah,
Talk
talk
show.
showy. Yeah, it's kind of a
kind
talk
of what
show.
we're doing. So.
We're doing it a little bit, talking about moving into Delaware, talking about rates, prices. It's a different market than somebody who maybe looked in 2023, 2022 especially, than is right now. Let's chat about it. You've been in the market how long? How long have you been doing this?
17 years.
On the mortgage side.
On the mortgage side.
And you, after 21 years in the Air Force, came into the new construction real estate sales world and now real estate. So how long in the real estate world?
Back into just real estate 3 years. Overall, like 12.
12 in the new construction side too.
Exactly.
Which is becoming a more popular option. We'll chat on that, especially with the relocators. But let's do a state of the housing market update. We're sitting here at the beginning of February, just breached in first month into 2024. Where are we at right now?
I think rates are coming down slowly.
Yeah.
They're more reasonable.
Which is a good thing, the slow part, in my opinion.
Slowly, yeah. It's
I
not
like that.
it's not mayhem.
Right.
I think inventory's still the biggest hurdle.
Yeah, homes for sale. We need more homes
There's
for
not
sale.
enough.
Need more options.
Sure.
Yeah. And because, there's plenty of markets in the past where you could shop for a home. Like, there were 17 options to go out and see over the weekend. Sit and think about it. Whole deal. That's not today, though.
Yeah.
It's not. Yeah, like when I come across let's say a new buyer client, and they give me their parameters, the county, the school district, whatever it is that they're looking for and the size of home, I'll go out there and put those parameters in my search criteria, and I might find 2 homes that meet what they're looking for, So, and then I send that to them and like, that's it. And I'm like, yeah, right now, that's it. Do we want to expand our parameters? Maybe we want to increase the price or maybe lessen the acreage that you're looking for or whatever. But it's a thing that the actual volume of homes to look for is slim.
It is slim. And to give an example for anyone listening, the last 48 hours, I was looking at that earlier this week. Our MLS setup allows us to set like a filter to show whatever snapshot we want. I want to see all of Delaware, any home that is active or coming soon, and then I want to see pending. The number of active and coming soon homes in a 48-hour period back in, I want to think back to COVID, because we were doing videos every day talking about that. Usual number last 48 hours for the whole state was anywhere between like 72 and 85 homes. Now, this last week, there was a time I logged on, it said 6.
Yeah.
6. That for the entirety of the state. We talk every Monday with our team about how the average amount of homes going under contract per month not only is lower than it's ever been from a month-to-month standpoint, but also this past year was the lowest amount of sales nationally since 1995.
Which is crazy.
Yeah. We're talking close to 29 years. The lowest amount of real estate transactions that have ever happened. When we're well below 7 billion people on the planet, I don't know the population of the country at that point between now and then, 30 years different. I'm sure there's a lot less people then than now. And just online, there's a lot less houses you can look at. You'd imagine just the potential at home sales back then is a lot lower than it is today. So to think we're lower than that?
And that's lower than like post 08, the crash.
Yeah.
So that's incredible to me. When you shared that number with us, I was like, wow.
And what was it, October? October was the lowest amount of mortgage applications since 1993.
Yeah.
That's an even crazier one because mortgage applications are done all online. So in 1993, there were more people who got up and went to the bank and filled something out with a pen and paper than people that went and faxed it in, then got online on their phone in their underwear in their bed and filled out a mortgage application.
Sure.
Yeah.
So where does that leave us today? Someone's looking to relocate into Delaware and they call you and they say, Mark, I want to get a mortgage. I want to buy a home, but is now a good time to pick up and move out of Connecticut and change my life up and buy a property that a lot of people are saying is too expensive in a time where rates are higher than they've been in comparison?
Yeah, I mean, I think it's circumstantial. You have someone moving from Connecticut's probably retiring or even relocating. Mm-hmm. Delaware's cheap still.
In comparison
to Connecticut, New Jersey, PA, New York.
Really all up the East Coast. I don't think there's a state you hit going Jersey, PA, New York, all the way up.
They're still shocked about how low our property taxes are.
Yes. Yes.
But I would never encourage someone not to buy.
Yeah.
unless that would have to completely not make sense with
What doesn't make sense?
financially.
Let's talk about that. What doesn't make sense?
Maybe someone that's just really stretching it debt to income ratio wise. They're super in debt. They're not going to be able to afford this.
They're going to make themselves house poor.
Correct.
Put themselves in a worse position.
But even in those circumstances, it still might be cheaper than renting.
Heard.
But
Let's talk about a realistic pre-approval, though. What's a number? Because here's a big gripe of mine. I don't know if you'll reason with this, but I can't stand when when a client, I'm not mad at the client, but I can't stand when a client says, hey, I'm pre-approved. I got my $185,000 pre-approval. Like, who gave that to you? That's not something we can work with. And it's not like I'm mad at the client. They don't know that. But they now think I can get a house for this. And it's not the case in the 2024 Delaware housing market.
So can I support the local lender?
Yeah.
So I think that's probably somebody that went online to 1-800-GET-A-LOAN
Or Rocket Mortgage,
somebody
Wells
like
Fargo.
and did something, and that's the number that spit out.
Yeah.
Probably not really a solid number, first of all, but definitely not a realistic number to purchase a home, because that number home doesn't exist. And I think if you're working with a local lender, that local lender is going to be able to say, based on your current circumstances, this is what you qualify for. However, probably not going to find a home right now.
Yeah, they're going to be real with you.
Yeah, and here's the things that you can do to maybe bring that number up in the future.
Yeah.
And then maybe they speak with you and they pass that information along, and you kind of nurture that client along the way over maybe the next year to 2 years to get them where they want to be.
And the beauty of Marc here, Marc, you have access to the code. You have the credit score language program that you can plug somebody in, and it's going to tell, because even in the industry, as long as, we got 40 years of experience plus in real estate, probably thousands of transactions. We all three agree the credit score system sucks. It's not a proper way to determine whether or not someone's financially viable. There's plenty of people paying $3,200 in rent every month that can't qualify for a mortgage because of their credit. But all that to be said, you have an application that if someone fills out with you specifically, your team can now say, hey, if you pay off this to this amount, if you move this account here, and you wait on this for 2 months and then pay it down to here, your credit score is going to go up 38 points.
Correct.
And that's one of the most valuable things I think you have access to.
Or you can be approved for a higher amount.
Exactly.
You pay
exactly.
X, Y, and Z. You're, instead of 185, you're up to 225.
Exactly. So you're not just handing it out saying, here's your new golden ticket to go buy nothing. Let's talk about how to get you to amount where, and maybe 225 is not the amount. What would you two say is like the minimum, not to take somebody seriously. I don't want to say that.
Sure.
Anybody we're taking seriously, but what's like that minimum amount? Like you can do some damage with this pre-approval.
If they're a realistic buyer, first-time home buyer, and they don't need...
Let's define realistic.
They don't need more than, say, a 3-bed, 1-bath, starter home.
Maybe
not
1.5.
crazy picky.
Okay.
Yeah. I can find them a home in the 250 to 275 range that's in a decent neighborhood, that they're comfortable with. They love the home. The home doesn't need much, so they're not going to have to put much money back into it.
I was going to say at least.
270.
I was going to say 250.
Yeah,
is probably. Well, you guys see it too, just from MLS. But there's not much out there for like 225 and below.
Yeah.
Oh, there really isn't.
If there is, it's a leased land manufactured home that ends up being more expensive than a $275,000 home.
Absolutely.
That's just education. They don't know. They see a home online for $175, but it's got $1,000 lot rent.
Yeah.
So,
or I had a conversation with somebody yesterday. I had a condo fee they didn't know about, or a big HOA, and it mows your lawn, but maybe you don't want that.
Correct.
So that's definitely something, the consumer information. Now, with that being said, the consumer right now is being led to think that buying a home is a bad choice. There's a lot of people yelling that the housing market's going to crash. What are you telling to that person that's saying, I'm sitting tight until the market crashes, home prices can't sustainably stay this high, I'm sitting beside and waiting?
For me, it's easy. It's the old, we on my end, I get rates. Rate. Rates are too high. Well, the old saying, you can renegotiate the rate, but you can't, or the rate, but you can't renegotiate the price you paid.
Date the rate, marry the house.
Correct.
That.
Yeah. So, you might buy a $275,000 home. Yeah, the rate might be 6% now, when rates dropped to 5, that home price would have probably been $300,000.
Pop that mic up a little.
You could have refinanced to the lower rate.
Yeah.
You know, or you can refinance to the lower rate, but you can't renegotiate that price that you paid.
But where's
for
the I hear your argument, and a lot of people will make that argument. Where's the guarantee for me that comes that the interest rates are gonna go down?
There isn't.
Yeah.
There's no guarantee.
Just like the housing market's not guaranteed to go up. It's just all you can do is go historically.
Down.
Yeah,
Yeah,
historically.
historically.
Yeah, historically prices go up, but rates fluctuate. So odds are, you know, at some point, you know, they're going to drop. I was telling Mark the other day, I was meeting with a couple that were from PA, and, you know, they were buying a second home, summer home at the beach. And he's like, you know, I'm talking to him a little bit about their financial situation. He's like, you know, I know rates are a little bit higher now than what they were. He said, but, you know, we're comfortable enough that we're going to be able to, you know, hold on to that rate for a little while. He said, but hopefully in 3 to 4 years, you know, rates will be at a point where I can refi and be a little bit more comfortable with it. So I think it's also finding that right client that, especially I do work with a lot of investors and a lot of folks that are buying second homes.
Yeah.
And those folks are a little bit more financially savvy, you know, and sometimes they're able to.
Well, more financially experienced.
That's true.
Yeah,
for sure.
I don't want to belittle anyone who may, you know, they have more life experience, a lot of those.
Sure.
You don't have a lot of investors who are in their 20s. You don't have a lot of, you know, third-time buyers or second home buyers that are below 40. So there's a lot of people out there right now that are just, man, kind of feeling stuck.
Yeah.
The relocators, though, for those looking to come into Delaware, I think there is an opportunity with the fact that, like you guys said, most people are coming in, relocating, looking to retire, selling a home, maybe in Connecticut, maybe somewhere else, and now has the opportunity to take that and buy really whatever they'd like in Delaware. But again, going to the buy the home now, like marry the home, date the rate, that's a tougher one because then, like you said, it has to be somebody who's walking into the home that can really afford what they have right then and there.
Correct.
With the anticipation of it being lower.
Yeah, don't buy it with the anticipation that, okay, in 2 years I'm going to have that rate drop
In order to survive.
Don't put yourself in that position. I never want anybody, because you talked about the house poor situation earlier. I don't ever want anybody to stretch themselves that far. You need to know that if worst case scenario, this is the best it's ever going to be, that you can afford it and you're comfortable with it. So.
Yeah, and I think when you said realistic buyer, I think the definition of that is someone who can look at the big picture, you know, meaning what you just said, you know, they can handle it now. Mm-hmm. If it extends 2 to 3 years, they're good. They can handle, if this is my rate, long-term big picture.
Yeah.
It's the ones that are assuming that, you know, like you said, it's not guaranteed, assuming that rates are going to drop to a point that it's a couple $100 more comfortable for them. That's where the education needs to come in. Mm-hmm. You know, you need to be prepped that this is it. You know, this is your mortgage payment the next 30 years. Let's hope not, but we need to prep for that.
Yeah.
You know,
the education side's huge because the interest rate too is something that a lot of people aren't 100% knowledgeable on. That if these rates do get down into like the low 5s, I mean, if we ever hit the high 4s again, it's a significant change to your monthly payment. It's not just home prices. It's a humongous factor, of course.
I'm the reality check. That's how I look at it. You know, everyone's looking online. Oh, I want $1,000 payment. Then they get to me, they're like, ugh.
Ooh, let's do that one. What payment are you seeing? Like if Vegas came in and said, hey, we need the good over under on what the average monthly payment is right now these days in Delaware. What are you seeing?
I would say for a first time home buyer, you're probably at like, that's in their comfort zone is like $1,600, $1,700, which is around, you know, $250.
And that's $250, $275.
Yeah, in that
So,
ballpark.
but if someone's looking in the $350, $400, let's say pretty much coming up to our median-ish, a little above, maybe second home, what are we looking at
You're in the
there?
twos. You're
well into the twos.
22, 22 to 2,500, depending on where it's at.
And things tax-wise,
Yeah.
of course, property taxes are being shifted in Delaware, not going to be drastic. Insurance, I just had an insurance guy in here. That's across the country. They've seen 30, 40% increases in premiums, and they're not there. He's an advocate for saying he doesn't think it's going to stop because they're on the tail end. He told a great little quip about, you know, back in 2020, especially because obviously most insurance companies insure everything, not just one specific thing. He worked for State Farm. were giving money back because people weren't driving during COVID. And they were giving rebates on insurance and helping people with their home insurance because they were putting their mortgage in a moratorium, and so they weren't paying their insurance. And the insurance company also said that's okay. And so year and a half later, caught up, and at the same exact time, inflation pushes things up 30-40%. Cost of goods, cost of supplies, cost of building a home, replacing a home is more expensive now.
Absolutely.
So they're catching up, and they can't do it like that, or they're just going to have people foreclose. And so they're having to kind of move at the pace of the market because, of course, if State Farm goes and says, all right, we're going to make up all of our losses this year, we're going to increase everything by 50%, everyone that has State Farm is just going to, I'm going to call Progressive. I'm not doing this. Right. So everyone's kind of doing the same dance right now of trying to get up to where they're more profitable. But then at the same exact time, if they do it too aggressively, they're going to go to the competition. But if they're fall behind, they're going to be losing too much money and then take on a bunch of people who think they're the better option and then lose it when they raise their prices. But ultimately, all that dancing to say, home insurance is a part of the mortgage, and that's probably going to affect people.
Correct.
One other question I think is really popular and one that I think anybody listening to this is going to want to have the answer to, and I don't think you're going to have an amazing answer to it. You're both amazing, but are home prices going to come down?
Small, if any. We are seeing that on, I don't know, probably a little bit more than half the homes. They're sitting a little longer, and sellers are starting to, maybe be a little bit more understanding and reasonable and dropping their asking price a little bit. So buyers are able to get that home for a little bit less than they, it was originally listed for because it's been sitting a while, and sellers like, I got to go.
Yeah.
So.
And can we talk about how crazy that is when we're talking about how we're in such a need for supply that even with the little supply we have, there's still a lack of demand?
It is. It's strange. And I wonder if my gut tells me, and I think we were talking about this earlier, is how buyers, there was such a frenzy for a couple of years.
Yeah. 2020 to like 2022 summer.
Everybody, okay, I want it. Everybody else wants that same house. So they heard all of that. And then those were the people that were some of those people were sitting back and waiting, or maybe it wasn't their time. Well, now is all they hear is, hey, there's not a lot of supply out there. There's not a lot of buyers too. So I can be very just particular and patient, methodical in the home that I pick. So buyers are just, a little bit more hesitant. So, sellers are kind of, dropping a price a little bit just to persuade that buyer to go ahead and go. I mean, I'm having conversations with listing agents prior to even seeing a home sometimes saying, hey, this house is X amount of dollars. My client, if they were to buy this home, would probably be 10 to 20,000 under that. Do you think your seller would be open to something like that? And they're like, sure, the house has been sitting for a minute. Let's talk about it. Schedule that showing. Let's see what we can do.
Do you see the advantage for your buyers seeing homes that have been on the market for a bit?
Oh, yes. All the time. That's the home that when I have a client that comes to me or I reach out to, I'm always hoping when I look on the MLS, I want to see that house has been sitting on the market for at least 15 days or so. So I know
15.
With 15, at least the initial
you probably got a bunch of showings right away.
Yeah.
The initial rush for that home. If
maybe
there is
that homeowner is a little like, didn't get that initial quick offer I wanted.
Yeah. So let's start being a little bit more negotiable, a little more realistic, maybe.
Yeah, and I was going to say exactly what you said, but to piggyback on it, until sellers' until sellers' expectations come down a hair, prices aren't going to come down.
Well, yes and no. I mean, seller expectation, right? But buyer market is going to determine the seller market.
Correct. But I think that the until the sellers, everyone, it's not 2021 and 2022. Like top dollar isn't there right now.
Yeah.
So like until they come down a little bit, maybe the values come down, but I don't think they're going to.
Yeah, because you're saying sellers aren't pressured into having to.
Correct.
Yeah, because what a lot of people would argue is the difference. What makes this any different from like 2008, where people stopped buying houses, and the main reason we got the inventory we got is because people were indeed forced to sell their homes because they had adjustable rate mortgages. They changed their mortgage overnight. They had to sell, and all this inventory hits the market, all while no one wants to buy. Now they have to lower their prices lower than what they owe, and now we have foreclosures. And that's what caused 2008. That doesn't line up now from what you're saying is because they're not being forced to sell.
Correct.
That main variable isn't present.
Mm-hmm.
They have a 2.5% rate. They're good where they're at. What's the motivation to sell?
Sean, can you look up the percentage of people that don't even have a mortgage? I believe it's over 40%. Because that's another number that people don't even talk about. We talk about, hey, where do we unlock this inventory? Well, hey, 40% of it isn't going anywhere.
Yeah.
40% of homeowners that have no mortgage attached.
At all.
That's fantastic.
And that's a lot of secondary homeowners and a lot of people that got rentals and a lot of,
Yeah, they're just paid off.
Of course. What's that? 39.3. I was off. I'm so sorry. It's not 40%. It's 39.3%. But interesting, a line chart showing how the share of mortgage-free homes increased from 2012 to 2022 from 34% to 39%. Can you look up what the number was in 2005, 2006? I bet you it was sub 30%. Because it used to be people would treat their home like an ATM with refinances. Mm-hmm. And it seems like over time, those same people who were burned are now being a little bit more astute and saving and keeping that, let's see, 2012. It doesn't go back any further.
Yeah, we
have start keeping track of this data after people started messing up.
We've had a slight uptick in cash out refis, but not like people would think. Mm-hmm. When I say that, they're pulling equity out to pay off debt.
Yeah, because that's such a niche. So I've had this argument with a couple lenders on two topics. One, the topic of talking about, hey, mortgages are 6 and 7%, but hey, credit cards are 12 and 15 and 20. I'm like, stop. That makes you sound financially silly.
Yeah.
We don't want to unpack that. I don't want to make you look dumb because it's very different. But the other topic is around whether or not to refi or sell to get that money out, because there are a lot of people to kind of break this situation down. Someone listening to me feeling this is a lot of homeowners are feeling the effects of inflation and feeling the effects of all the affordability issues we got going on in our country. Mm-hmm. Food, power, supply of everything is an issue. Those people, like you said, sometimes are leaning on a cash out refi to say, pay off the car debt, pay off the note, pay off the, the fence that they got from Home Depot and restart. But that comes in lieu of taking on that 7 or 8% or 6%
Correct.
Or whatever mortgage they're refining to.
The next question would need to be after that, well, what are you going to do if you sell your home?
Yeah.
Are you going to reduce your monthly payments?
That's the catch 22.
Because you might think it's a better spot.
Yeah, that's the catch 22.
But you might do a lateral move to the same type of home and just be more, have a higher mortgage.
And a lot of those people, how many people? So if nobody knows right now, credit card debt per household is as high as it's ever been. We're over $1 trillion in debt as a country in just credit card debt, and more people. I think it was October. It was like more than 50% officially are officially paycheck to paycheck. Like
I believe that
if they didn't get their one check, they would not be able to pay something.
I believe that.
It's a nutty number. But with all that being said, to what you just said, like where do they go? A lot of those people can't even afford a mortgage anymore. A lot of those people couldn't even qualify anymore because their credit's been jacked up. Let's see, 76% of U.S. adults who make less than $50,000 are living paycheck to paycheck. Remember when $50,000 was completely normal compared to 65% of those making up to $100,000 and 47%. So 47% of people who make more than $100,000 in America as of September 18th, 2023, it looks like it was done by bankrate.com. They're pretty legit. Are living paycheck to paycheck. 1 out of 2 people making more than 6 digits.
Yeah, and probably a more disturbing graph or display would be.
Could you bring up that bar graph on the right-hand side?
You should do like home prices in 2010 with the average income compared to today.
Oh, sure.
Oh, yeah.
It's probably
they're not
the home
they're not
prices
equal.
probably
there was a TikTok. I need to start saving these and sending them to you, Sean. But there was a TikTok. There was this guy who's like going to buy a home in 2012. He's like, hey, I want to buy a home. He's like, okay, what do you do? He's like, oh, I do this. I make $36,000 and I got a couple cars. He's like, we're gonna be able to get you into a home, son. And then it's like 2024. It's like, hey man, I want to buy a house. And the guy's like, all right. He's like, What do you do? He's like, I'm a tech engineer. I make $127,000. I have no debt. He's like, stop. You're not gonna be able to afford a house.
Yeah.
Wow.
It's like, and it's
because the pay hasn't gone up much. It's like 5%, but
income issue. It's an income issue. This is not realtors being greedy or corporations buying up properties. This is businesses at every level, from mom and pop up to Tesla and Google, that aren't providing enough income per person. And a lot of economists have said, if you just look at the graph of like, hey, we have more population, we're going to have more people that need to make money, we have more adults that need to make money, and we have more people graduating from college and leaving their parents' household than ever, needing to make money, and there's less ways to make money in the corporate world. And it seems like there's less and less opportunity each day in the corporate world as tech and AI and all these things are starting to move in on that job market. So does that number change? Should someone now expect, I got to make $100,000 to buy a house? Is that the long term?
I don't think around here.
Yeah, because to put in perspective, California is like,
Yeah.
you got to make $148,000, I think is the number.
Yeah.
Right now to qualify for the median home. Wow.
Yeah, I mean,
And their median home is like 800.
obviously there's other factors, but
2
I
bed,
mean,
1 bath.
again, a 200, let's say it's $1,500 a month. I mean,
Yeah.
you gotta, with no other debt, you gotta make like $3,200 a month, $3,300 a month to qualify for that.
Yeah, but that
I would never recommend someone do that. That's
Yeah.
eating up that much of their income.
So even talking about that, let's talk about bare minimum. Let's talk about moving into a median home, $2,200 a month, normal person, 25 to 35% in debt to income probably. That person's probably having to make $8,000, $9,000
Yeah,
a month.
Yeah.
So and that's $100,000.
Yeah. Yeah.
So it seems like the average person who's doing financially well, like not making bad decisions with their credit, putting
It's
some
tougher.
putting
It's
some
tough.
pennies away.
It's
Yeah,
tougher.
It's
like
tough for them too.
it's exactly that person who at one point would be able to walk into a mortgage office and just be treated like a king, and just like the type of person where I get off the phone with them like, Mark, easy one, coming your way, let's get out and see some homes this weekend, is not that way anymore.
Yeah.
So what are the new standards? I'll give some perspective. I'd love to hear like what the 2024 buying guidelines are from you two. I'll give you what I would say the 2021s were. I would say you have to have at least a credit score of about 600 to 620. We can work with a 560, 580, but on much less wiggle room. You should probably at least have $5,000 in your pockets. 10 grand's better. We have programs for 100% financing, but FHA's 3.5 is probably the best route. And then your job, be there for a year, and as long as you make more than $32K without an obnoxious amount of debt, you're probably gonna be able to buy a house. What would you say those compare to today?
Double that salary.
So you're saying 64,000.
Yeah.
Credit score around the same?
Yeah, 620 is like the sweet spot where it opens up different avenues. But
Could I shout out your team though, in lieu of
Yeah,
hopefully
yeah,
you're not
go
getting
ahead.
a bunch of calls? Let me shout out your team. I know there's a lot of ways to shout out your team, but you guys just got someone not pre-approved, someone who's under contract to buy a house, 492.
492.
That's crazy. And,
Now
and
look,
everybody with a 492, don't start calling.
Look.
They have
Let's
a co-signer.
let's read
be
the
very
fine
clear.
print. Let's read the fine print. Yeah,
There's a co-signer.
Yeah.
But I was shocked and amazed that they had a product that could help somebody
Yeah.
like that. And this person, it isn't a debt to income situation. It was simply a credit score issue, like you talked about before. Maybe it isn't always the best way to gauge somebody. Maybe somebody had some mistakes. Maybe they went through a divorce.
Yeah,
whatever.
it's a real silly
Yeah.
way to gauge somebody.
It is. But
And that's the way they track it. It's just there's no rules anywhere of like how this actually all works,
Yeah,
right? Everyone has some rumor of how they think it works. Oh, pay your credit card early,
Exactly.
like-
Now the 620 is like the sweet spot. So
620 credit
when
score.
when you get
Can
down,
we clarify that real quick? Because we're talking which one? Because there's three, and then some will say it's
we'll
your
go the mid score.
TransUnion,
The mid score.
The mid score.
Whatever.
So if I see all three,
Yeah. Whether
not
it's
on Credit Karma,
not on credit.
where do I
not
know?
on Credit Karma.
Again, but but this is a consumer information
Yeah.
issue. This isn't their fault. So where do you go?
So we do a tri-merge with Experian, Equifax, and TransUnion.
Where can I do that on my computer or phone? If I'm watching this, I want to check my credit scores for real.
You can get a free annual credit. I think that's actually the website. It's
Annual-
Freecreditreport.com?
No, I think it's freeannualcreditreport.com.
no, but I think it's free annual credit.
Free
report.
annual-
Free
Also-
annual report. It doesn't
Yeah,
sound as
yeah,
good.
yeah.
Most
Doesn't
banks,
flow as easy.
most
No.
banks will also do that for you as well.
Correct.
And they're pulling from the same things you are.
Correct.
So if you have a checking account or savings account somewhere, you can reach out to your bank
Correct.
and they can provide that.
Yep.
Now, below the 620 is where you might need to have what's called compensating factors. Reserves, meaning backup savings after the transaction. Very low debt to income ratio, maybe. Solid rent history.
Yeah. Other properties you may own.
Other
leverage.
Yeah.
Retirement accounts.
Correct. So, yeah, we will go down that low, but there's got to be some other positives too. Yeah.
Yeah.
So.
To maybe put a tie on that, it's a gray area, and there's other factors that you can bring to bat for somebody that maybe goes against the typical. If you do have money, properties, past history, something to prove to this bank that you're going to hold this mortgage and do it well.
Correct.
Got it. But again, 620, $64,000. What else are we saying is like, hey, our minimums? What do you want to see in the bank account? I used to say anywhere you can do it with a couple grand. 5,000's really where you should start. 10,000's best. Where are you throwing those numbers now?
Yeah, if you're at a 620,
64,000.
Decent debt to income ratio, you always want to be prepared to have some cash. Like 100% financing is never 100% financing, no matter what you hear. Yeah. Someone's paying for it somewhere, and it's mostly, unfortunately, the buyer. There's still inspections, there's still appraisal fees, you still need a deposit. Yeah, a lot of times we can get that back for you, but it's just moving numbers around.
Yeah.
But to answer your question, how much cash? If you're that low, or not that his 620 is bad, but it's not great.
Yeah, don't come at my score.
Yeah. But I always say try to have 3 months reserves.
Yeah.
So if your mortgage, let's use easy numbers. If your mortgage payment's $1,000,
let's use realistic numbers. If your mortgage payment's $2,000,
$2,000, yeah, $2,000. You want to have $6,000 after the transaction
in reserves.
And
that could be an investment account.
Could be a retirement account.
Retirement account. There's a retirement account. Does that count if I'm like 32 and that money's basically inaccessible to me though?
You have to be able to show that you can liquidate it.
Okay, so probably not then if I got like a company run.
You have to be vested. Yeah. So sometimes yes, but a lot of it helps though.
Yeah.
It's showing that you have something.
So 3 months reserves is best. But then also the money that goes into just frankly needing for closing costs, down payment.
You have to figure that out, whether you're getting...
So what's like a guideline? Like if you were to say to someone on the street, hey, if I just said, hey, how much money do I need to be able to buy a house? What's the middle of ground number? Like I said, 5 was the number, hey, get started. We can rock and roll. Is that number closer to 12 now?
No, I would go off the purchase price.
Okay.
If again, maybe rule of thumb's 3% of whatever the purchase price is.
3% saved up as to whatever.
But
the purchase price is.
I like to use it as in terms of reserves, meaning 3 months worth of mortgage payments.
Money after.
Correct.
Yeah, because that's the real money you need. It's not just the money to buy the property. Like you said, sometimes that's moving money around.
Correct.
Numbers. We can get the seller to pay this. We can get a credit for
that.
Got it. So we would summarize this to say you should probably make $64,000 a year with a low to minimal debt. And those debts include things like your car, things like student loan debt, and all of the credit card stuff. Mm-hmm. All of that is just their monthly minimum payment. It is not the lump sum looming in the background that maybe keeps you up at night. It's the monthly minimum payment, correct?
Correct, the minimum payment.
You only care about how to pay the mortgage.
You could have a $500,000 student loan.
You don't give a damn how they're going to pay that shit off. You just
want
to make sure they can pay the mortgage.
We're going to go off what the payment is on the credit report.
Heard. No, I hear you. And with that being said, though, you want a minimum amount of that if you can.
Correct.
But again, even if it's a big lump sum, that minimal payment is what they're looking at, the mortgage company. We want savings at least probably 3%. Let's call it 10 grand, 9 grand to get started probably. 620-ish credit score is that sweet spot and above. Are there benefits to having a 720 credit score versus 620 in a market like today?
Depending on the program, it's going to impact the rate.
Okay, so what about like first-time home buyer? I'm spending 3.5. Okay, so that starts to really factor in when things start getting gray.
Correct. I take that back. So if you're using like the Delaware State Housing Authority program, those rates are set in stone.
Yeah.
But if it's a regular FHA loan, it is going to impact the rate.
Which, by the way, we can't speak in detail about right now, but if you're looking for like the first-time homebuyer program of Delaware State Housing Authority did just put out a program. As we sit, it's even not like officially usable. So I don't even want to give details because we don't have 100% of them. Right. I don't want to mismatch. But hit us up. If you are looking for like, how do I get my down payment covered? How do we get closing costs covered? How do I maybe get a lower interest rate? Because it was talking about the fives, even mid fives, and money back for first line workers. Like you said, you have some clients that are nurses, military, something to talk to us about. But we're looking at a 620, 640. We're looking at 3% in reserves as well as money on top to be able to pay that closing costs and potential down payments.
Just in case, because again, there's a lot of ways to maybe you get the seller to cover closing costs.
Or like a DSHA or something
using
like
a
that,
VA loan or USDA
military.
or a DSHA product. There's ways to get that covered. Don't rely on that.
Exactly. It's not relying. You get
Correct.
more cards in your hand at your disposal to negotiate with, for repairs, for all these different things when you have cash.
Correct.
Cash is king in that regard. Because you do have a deposit. You do have inspections. You do have appraisals. There are fees that go with it.
Look, it goes back to what we were originally talking about. It makes you look more prepared to the seller, too. If you're going in and you're not asking for 6% in seller's assistance to cover closing costs, you're probably going to get that deal compared to someone that's asking for it.
Absolutely.
So I think the biggest issue is just buyers aren't prepared. And that's where I help, but they got to come to me first.
And that's why we're here, because I want everybody who works with us to be prepared.
They have these lowballed expectations on what their monthly payment's going to be. They have no clue that it includes property taxes and homeowners insurance. They think they can get in with literally nothing and they don't need anything, period. And that is true in some cases, but it's tough. It's very tough right now.
It's harder to do when you're already at the baseline of approval.
Yes.
You got to get far past the minimums if you want to get into certain things like that.
So if someone came up to me without doing anything, I would say save money.
Save money.
Yep.
Save money.
Yeah.
Cash can cure a lot in buying a home.
I see a lot too because when I'm talking to a buyer, especially a first-time home buyer, I'm trying to do some pre-qualification over the phone. I'm trying to find out about
a soft pre-qual.
What they're looking for in a home, but I also kind of find a little bit about their financial situation.
Yeah, we're not pulling their credit.
Nope.
What they're due for a living.
Exactly. And when somebody tells me 99 out of 100 times, if somebody says, when I ask them the question, do you have any money in savings? And they tell me like 10 to 20,000, I'm like, that person 99 out of 100 times is going to be a very viable buyer client because that person is typically fiscally responsible, probably has a pretty good credit score. They're making a decent amount of money to be able to put that money away.
They have savings.
They've been able to do that. So I feel very comfortable at that point, working with them, moving them along to Marc or another lender to make sure that all the other, T's are crossed.
Yeah, funny you say that. That's a great variable now that I think about it. Usually, like you said, everything else kind of lines up.
It does.
When someone does have that money.
You have a pattern of savings.
You have a pattern because all the other things you need in order to buy a home usually kind of come with the skill set required to save $10,000, $20,000.
Unless like mom and dad had gifted them.
Which is another thing that can be done.
It can be done.
Do you see more of that happening? I know you can't specifically say.
Yes.
But do you see that as a future progressive? Don't touch my foot again. If you see that as a future progressive, like happening more and more?
Oh, 100%. And it doesn't even necessarily need to be.
Because there's a lot of studies. I don't even know what you would Google that show that like the mass amount of funds in America are held by like 45 plus.
Correct. And maybe they're not gifting funds for down payment or closing costs. Maybe they're paying something off. I've seen that too.
Okay, guys. So let's talk that person. Let's say grandma's got $15,000 to throw at you, and this is a very niche situation. And I want to read this here in a second. But what is? Oh, can we look up a net worth chart? That's probably what's going to best show it by age. What's the best money for that to go into? Is it better to say, hey, here's $15,000, go buy a house, or hey, let me pay off your credit card?
I guess it depends.
9 times out of 10. 9 times out of 10.
Are they under contract?
We're getting prepared. We're getting prepared in this situation.
I guess it depends on
how bad their debt would be.
If that credit card payment isn't impacting them buying a home.
Yeah.
But the problem with that though is if they pay off that card, they could re-rack it up.
Yeah.
So I mean, the easy answer is probably paying off the card, but there needs to be a plan after you pay off that card.
Yeah, because as grandma, you have a guarantee the $15K is going into equity, which
Correct.
doesn't go away, versus this $15K go back into a shopping habit.
Correct.
How quickly?
I need you just bought a home. I need the furniture place. So next month that
And then you get into the situation we brought up where a lot of homeowners today, I'd argue it's probably the highest it's ever been, where current homeowners could not qualify for a mortgage.
Wow.
Ones that already own a home?
Yeah, ones that already own a home. I don't have a number on that. I don't have a graph, but I would argue as we sit right now, there's more homeowners right now that could not turn around and get a mortgage right now.
On a basically a similar
or just their own home.
Sure.
Like imagine you bought it when it was 150 grand less with a 2.5% interest rate. Qualifying for that home is much different from qualifying for that home today. I'd argue there's a lot of people that are financially stuck in their houses that couldn't even qualify for their own home. And you look at this graph right here. Look at 20s. Median's the number you want to look at. Average gets shifted around by the trust fund babies. But median net worth in the 20s is $7,000. So you're talking to up until about 29 years old, the median person, which is the normal average American, the home buyer, the first-time home buyer, it doesn't even have 10 grand to their name if they bought or if they sold everything they had. And I'd also make the argument, and maybe this isn't taking it into consideration, but there's a lot of graphs that would show the median net worth in the 20s as of today for most to be in the negatives due to debt. But this shows it in the positives again. But then once you get into the 40s and 50s, you have 126,000, 292,000, 454,000. All the money is being held up there. You look at the 30s, up until 39, that person's still not even worth 40 grand. If they died today, they're not worth more than a year's salary. That's kind of a crazy way of how our economy is set up right now. So I think there's a world where a lot more family, community, a lot more, hey, I'm going to buy the 10-acre. The grandpa buys the 10 acres, and then everyone else comes and brings in their properties, and we live on this homestead. There's graphs of this that show how drastic it is. The numbers definitely show it. But a good bar graph, I mean, you just see nothing. And it's getting more drastic every day.
When do we start seeing mom and dad who let's just say they're late 40s, early 50s, and junior graduated college and had a job, maybe lost a job, couldn't afford to get out into the housing market. Mm-hmm. And to help them out,
oh, there you go.
Mom and dad are giving them the down payment money. They're like, this, we've got to get you out of the house, but
there's enough money there. Hey, yeah.
The kids can't get out otherwise without having some additional
funds. To define can't get out, because there's going to be some boomers, sorry, that listen to this. You guys aren't boomers, but
close.
You're getting there. People are like, well, we worked for it. We had to grind for it. We had the 2 jobs. We worked through college. The numbers just don't make sense for that today. There are people, we just talked about it. You can make more than 100 grand, you can't buy a home. You're poor in terms of home buying if you make no more than 100 grand, or don't make 100 grand, I should say. And like this net worth chart, a little bit more eye-catching. Under 35 years old, says the median's $13K in median net worth. Under 35. And then you just skip to 35 to 44, you're almost at 100K. And then it keeps moving up. These are completely different numbers. And I honestly don't know who Visualist Data Stream is. So I don't know if these numbers are legit. But it's 2019, so the numbers are probably a little bit more aggressive at this point. But regardless, both of those, whether the numbers this or that, show the disparity of money between these groups just based off of how long they've had the chance to live on Earth, which none of them got to choose.
I think most parents, and I know personally I would do this, I would rather give up the cash to get them out on their own.
To get you started on your own retirement.
Exactly.
Yeah.
To let me become an empty nester, I would certainly say, here's a little money to get started, go do your thing. Where otherwise they
or buy a property and rent it out to them, or
yep.
Provide sign on to co-sign like you had mentioned before is another option. That's a common one. Can my mom co-sign with me? Blah blah blah. Which the answer is always
yes.
Yeah, they just got to qualify with their credit score. But it's interesting. Oh, we got another graph. So this is up till 2022. Household financial assets.
Wow, that
you see 2008 happen.
Peaks and valleys?
Yeah, sure. But I mean, even just look at it. It hasn't gone up much.
No.
From 89 to 2022.
No, and you think about all the expense. You got talking to your mic. You think about all the expenses that have lined up between then and then.
Yeah, I mean, normally it's like this.
Yeah.
But that is...
Wow. Median
net worth based off Americans, again, a graph. This looks a little bit too even to be true. Math never looks that pretty. But and there's the kids they found that don't have money.
Living in mom's basement.
Yeah, these graphs are way too pretty and just raise like staircases. And then a family in bed, again, with not much money. He looks like he doesn't have money.
Well,
He looks stressed
He
out.
looks stressed as hell.
They're in a one-bedroom apartment. I mean,
She
come on.
doesn't know they're
She has
that
no
broke.
clue,
She has
right?
no clue he's out of a job. 40, starting to get a little bit more confident. All right, life's not that bad. 50s, I bet he's smiling. Oh, wow, she looked
Ooh,
concerned.
she looks angry.
She looks
They're
concerned.
going to show 70s. There's still like a Walmart greeter.
Nah,
They're on the
now
beach.
they've officially begun
They bought a house for me down at the
I
beach.
thought they were getting.
They're
you know,
officially
they
a part
they
of the
were
medicine
still,
commercials.
I thought they were still going to be working.
Well, have you seen the video of Nikki Haley talking about the new retirement age should be closer to 90?
Oh yeah.
Because people's life expectancies, they're expecting to be in the
Goodness.
hundreds within our own lifetime.
I got 50 more years.
But let's be honest, people like us, I mean, there's probably going to be some form of entrepreneurship or work up until it's feasible. I can't see myself just one day sitting on a pier every day and looking out over the ocean.
That actually doesn't even sound fun to me. Like, I want to be on a beach drinking like every day. You wanna be-
Vacation? Sure.
Yeah.
Every now and then. I'd probably
not-
want the same amount of vacation in my life as I do now, which once a year, maybe weekend or two. I can't imagine, like you said, every day. The beach life is my life. It seems a bit fun.
I would get bored.
But if anybody wants to do that, Delaware has some great beaches to make it happen,
If I'm living the beach life, I'm still selling houses at the same time.
which is a great place to be selling
Yeah.
homes. So again, money could be coming from parents. Money could be coming from other sources of generations within the family. But man, I'll speak on something that doesn't have anything to do with housing that I think I have a little bit more of a view on than maybe you guys have, if that's all right. It's not all right?
Is he saying because we're old?
Yes.
Okay.
Yeah.
Sure.
Generational gap, we'll call it. All right.
Okay.
Generational gap. There's not a lot of people in your age demographic, majority-wise, that are complaining about the economy as much as a Gen Z or a younger millennial would be right now. There's also not a generation that has ever existed, such as Gen Z, Gen Alpha, and younger millennial, that have had unlimited information in their pocket 24/7 for the rest of their life. Never happened to you, but they're raised with it. And I think that the American dream of homeownership has kind of shifted a little bit in their eyes. And I think there's a lot of people who are okay with understanding they're never going to buy or think that the government's created a world where they're never going to be able to own. Do you view it that way? I'd love to give my perspective again from my view. But from your perspective, is this just another generation where you got to say, hey, look, it sucks sometimes, buck up, work through it, and it'll be shiny on the other side? Or do you say, hey, look, this is a lot different from when I did it. Yeah, this is how I did it. But right now, I don't really know if that's the right way to do it.
It's definitely a different world. Like just the way that the younger generation makes money. They don't necessarily have a 9 to 5.
Or don't need to. There's other options.
There's other options.
Yeah.
Making
Or in
money.
an office.
Yeah.
Or that's a great one. Yeah.
So many people they work differently. You know, the understanding was when I was 25 years old is you had a full-time job, you went to that job, and, you know, at the end of the day, you went home.
Graduate college, get your job going.
Whatever,
get your house,
yeah. You know, and it's definitely different. So I would let that person know that, yeah, it's not going to necessarily be easy, but with the right direction, it can still be an option for you. But it may not be for everybody. I mean, there's a lot of changes, and COVID had a lot to do with that. The way people work, the structure of a normal day is so different for a lot of people than it was in 2019.
You're absolutely right.
To hit what you said, I think there's so much information out there that the younger generation overthinks it. Where I feel like, I don't know, this is just me. I was like, I'm going to do it and we'll see what happens. You know, I knew I was going to be okay. I'd figure it out. And I feel like there's too many opinions going on. And some people just don't think for themselves sometimes and say, I want to own a home. Yeah. I'm going to do what I need to do. I will get in and then figure it out.
But what happens when that person just can't figure out what that is? Like we talk about the numbers, right? Let's say I make 48 grand. I need to get to 64 grand. Like, what do I do? Like how
that
how
I
do-
can't, that,
that's the problem.
Yeah. And I mean,
But I get what you're saying, and I think a lot of that, the paralysis by analysis is
correct.
what they call it.
Exactly.
Mm-hmm. There is a lot of that. 'Cause
We
there's a
have
lot of
buyers like
information
that.
available.
We have,
Of course,
they're,
yeah.
they're just overthinking it. And we're like, do you like the house or not? Like,
do you want to live here?
Yeah.
You had 20 things that we needed in this home.
Correct.
I got you those 20 things in this home, and they're still contemplating.
And we're not talking about buyers that can't afford it. This isn't
that person.
This
yes,
isn't a budget issue. Like they qualify.
Easily,
They are just, well, what about this and what about that? And I'm like, you live in New Jersey. It's like where this one particular buyer's at. It's a little more strict. You know what I mean? And we're like,
and expensive.
Delaware's Wild West in some
is.
cases. Like, you're just not going to be an HOA. Just things like that. There's just
6 houses back, then shrunk to 3 houses today. Department of Housing and Urban Development data shows that the median single-family house in the U.S. was worth $84,300 in 1985, or $241,000 in 2023 money. That means that 38 years ago, $500,000 could buy just shy of 6 middle-of-the-pack houses. Wow.
Now, what you need to do is go to the income.
The income is drastic. Yeah, I was hoping.
Go 38 years ago to
let's look at
today.
the 1985 income versus today. Exactly. So if the average home is around $80,000, and I'm assuming the income is in or around that high teens to 20s, we're now talking it's not even really doubled since then. Meanwhile, the household average price has gone up.
I'm going to say
times.
it's closer to 30 in 85. But
I would say it's probably gone up 25%.
While home prices and everything else has gone up 400,
Correct.
500, 600%. Yeah.
Right.
Looks like you're looking for it now. All right. So income data in the report from 1985. The first estimates based entirely on households selected from the 1980 Census Bureau, blah, 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 blah. Income of households. Median income in 1985 was $23,620, an increase of 5.4% from 1984. All right, and then it looks like it went up another $500 in 1985. What's the average income in 2024? Could we do median income in 2024?
So I feel like
that was an average.
I was like, I'm a little low.
Let's do median. So 50,000, it looks like in that one. 50,000, 20, 34 an hour, 59 is the average. Average is always going to be higher than median. Median's the more accurate number. Yeah, let's look at Delaware. We can get more specific. 60,000, it looks like. Are you able to click it or?
Orange doesn't even have...
Does it scroll down to something up here?
Yeah, that's
What's
60.
Orange? You know, I was supposed to... No, nothing. Oh, I guess you could scroll down and find Delaware. Arkansas, 20 grand.
Go Hogs.
Yeah, Delaware's got to be somewhere in here. New Hampshire.
I think that last graph said
Georgia,
60.
Wyoming. Grass says 60, you said? United States. Are we not a state anymore? We're not one of them? This is not here? All right. Well, either way, just that shift right there, we just saw average income was about $23,000 in the mid-'80s, and now as we sit in the mid-2020s, 40 years later, our median income is sitting in the 50 to 60 range. So that's 2.5 right around there times, and the buying power as far as a home, has shrunk dramatically because we went from an 80,000 median home to a nationally, because that was a national number, 420 median home.
Right.
That's drastic. So is that the direction we continue to go? Is there a pullback? Do people just need to button up and make more? Is that really the answer? If it's the answer, it's an unempathetic one. But if it's a real one, it's a real one. How are we finishing this off?
Well,
we're almost at an hour here.
It's easy to say go make more money.
Well,
but
yeah.
But I'm saying
easy to speak the words.
Say it.
Yeah.
To do it is a different story.
Well, you can spend less and save more.
That's another one too. I think we're also in a generation where things like I'll shout us out, Gen Z and Millennial, of like a Grubhub, of you don't look at the fact that your cheesy gordita crunch that you're conveniently getting has gone from what was a $5.50 taco, which by the way probably in 2003 was like a $2.50 taco. Is now like a $8.50 taco,
and you're paying the service charge,
and you're DoorDashing it,
and there's a fee for the delivery, and there's a tip, and now you make this the 4 times a week routine, and now you've spent $200 on food.
How about your $8.50 coffee twice a day at Starbucks?
I won't get on that train. I won't get on that train with you. Because if there's a lot of people who A, need coffee, B, the average price of coffee is more like 6-ish. And
people used to make their own coffee.
And if you look in exactly, they did. But if you look at the cost analysis of making your own coffee versus doing that, you're barely like saving $1,000 a year. You're not changing really. Nothing. Okay, yes, $1,000 a year, but then we have, and it's doubled, right? A little bit more than doubled. Is it really? Okay. So it's going up.
85 was my first year working.
Good for you.
Yeah, 335.
Why did you wait 40 years to start working?
Yeah, I was lazy. I was ahead of the curve on the Gen Z thing.
Well, I want to give just at least a little bit of insight. Again, we're live on Instagram, Zachary.Loft. If you're listening to this one, watch these live. But anyone watching this, YouTube, save money, get your credit up, align yourself with somebody if you're talking spouse, family member, friend that you're going to bat with that's doing the same, credit and money. Anything else?
No, I really want to speak to a lot of the clients that we see coming to Delaware, that are older with a little bit more money maybe in the bank that can help out their kids.
Yeah.
Think about the idea of helping them out with a down payment. Think about maybe you're the one that's buying that home because now it's an investment property for you and you rent to them. Maybe they can buy it from you later, or maybe it just becomes a long-term investment property for you until they can move on to that next home.
Mm-hmm.
I see a lot more of that.
Yeah.
Any other?
No, I think you hit it on the head again. I think save money. That's obvious. The credit karma apps, use them for credit monitoring. Don't necessarily use. It's
They're not the
scores on there is not
my
gospel.
credit score.
Yeah, that's just
it's an algorithm, isn't it? It's guesses.
Correct. And just because it says an 800, you're probably like a 680. So take it for what it's worth. Use it for the tools that it offers, not necessarily to not to update your credit score. And I can't say this enough, make payments on time,
12 months worth too. Cause if you're sitting, you're sitting there thinking, man, my credit's dirty, a good 12-month run cleans you up pretty well, right?
Yeah. And correct. And a lot of things we're seeing, like you get these medical bills in the mail, you got to pay them, they will send it to collections.
Correct me if I'm wrong, though. Once you've paid it from collections, it's as if it was never there, right?
Yes, but it still could do damage to the score.
As it's there.
Correct.
But then once it's gone, it's as if it's never there.
They say it's supposed to be, but
sometimes it's not the case.
Yeah.
It's what's qualified as medical
otherwise,
debt.
Yeah.
Okay, interesting.
So just, make your payments on time. Those bills need to get paid that you're getting.
Yeah, unfortunately, because with income being lower than it needs to be and everything being more expensive than it has been, a lot of people are probably falling on, and we know, using credit cards. And we knew back in November that the data came for October of 2023 that more people were up to 60 days late, which is like the Liz Pendez range when they issue you a document saying, hey, like you're about to lose your house than ever in October. A lot of people said that was due to also the moratorium ending, but there was a lot of people. We even got the calls of people like, we got to sell. We can't hold this payment anymore. One other topic to bring in as we literally clock in around the hour. Have you guys heard about the silver tsunami? Heard about that?
I have not.
Silver tsunami. So it's this thought process that the 40s, 50s, and 60s, especially 50s and 60s, ones have accumulated, their home's worth a lot more. They didn't have car loans anyway. They, they're not really affected by interest rates. Kids are out of the house, sitting on cash in retirement, right? They're going to maybe potentially make their move into retirement a little sooner than maybe they thought they were going to be able to because things are worth a little bit more than prior, which is going to lead them into, vacation and secondary homes, of which parts of Delaware you could argue may fall into that category, but that's not really the main point. Main point is that grouping of people retiring early could offer a large supply of housing that isn't exactly filled because there isn't enough demand to back it up. And there's a rolling theory that within 3 to 5 years, that could crash the market.
You're saying it's because they want to get out of there. They want to cash out.
Yeah. You're living on Main Street. You're living in the community. You raise the kids in. You're doing whatever. And the game plan wasn't to retire there. And now you have the opportunity to do that early.
That would be area specific.
It would absolutely be area
Florida,
specific. Absolutely. Exactly. Certain places like Florida would continue to see an influx of relocators
other places would get.
Other places like New York, big heavy work commercial areas would see people leaving. Big suburban areas, maybe in Delaware, you could look at the $400,000 to $600,000 neighborhoods, which again doesn't solve the problem that we're currently going through. The big issue that could come with this is we could be left with this gigantic influx of homes that are 4-bed, 3.5 bath with a basement that aren't needed because Gen Z is having the fewest kids of any generation. So is millennial, and it keeps trending down. A lot of that you could say is because people are choosing to have less kids and then medically are able to have less kids. And then we have all these retirees that are ready to get to Disney World. And now we're left with neighborhoods full of 4-bed, 2.5 bath homes that just no one wants. We need 3-bed, 1.5 baths.
I'll give you another example of that. And I'm kind of one of these that to the point of let's just say you could retire at 50 and you're like, well, my plan was that I was going to sell and maybe upgrade or maybe go to the beach or move to Florida. But you know what? I'd rather just retire, stay in this house, not sell it. So again, it doesn't hit the market. So it doesn't give that first time home buyer, that move up home buyer, the opportunity to purchase either. So it's another negative on the listing side, on the, just the sheer volume of homes available for people to purchase.
They're saying stay put, live more comfortably.
Yeah, exactly.
Yeah.
Just maybe not have to work as hard, have a little bit more money in the bank, travel more, but I don't move. I just stay put.
Other option, you do move, but you don't have to sell it. You keep it as a rental property.
There you go.
You give it to that son or daughter or cousin or family member.
We're seeing more and more of that.
Yeah.
We're seeing a lot of
let the family
parents selling to kids.
Or renting.
Renting, yeah.
That's interesting.
Yeah.
And a lot of people listening like, where do I get that parent? Where do I find that uncle? Where do they sell them? All right, let's finish off this topic. Let's finish off this conversation. Anything that somebody's listened to all of this, we've been on now hour, 3 minutes. Anyone sitting here listening right now thinking, man, do I buy? Man, do I think about investing? Like, what are you telling this person? How are you summarize this conversation for him?
Always buy.
Well,
All right, salesman.
I would say that don't assume you can't.
Yes.
Talk to a professional, and
A professional what?
a professional realtor, professional lender.
Which one?
Both could be both. I
Okay,
mean,
but I'm indecisive. Tell me who I call.
I would start with the realtor because I think the realtor maybe might know the market a little bit better, to know what's available for you, and then any good realtor has got a network of lenders that they can pass you along to for that information. But at the same time, if you want to start with that lender, because you don't want to share your financial information with that realtor, you don't want them in your business at that point. Talk to them, and the same works for them. They have that network of realtors that they could pass you along to.
I agree.
Ditto. All right, gentlemen. We'll jump on here probably another week, or another month or so. I'm sorry. Jump into what's going on. Going to be entering into the spring market. Do you see a change happen in spring for those listening, hoping for a quicker move than later?
If typical.
Yeah, I see a
year,
slight increase in inventory,
sure.
More seasonality than anything.
Normally the realtors see it before we do. I think your sign is when you see more homes pop up, right?
Well, I wouldn't say it's homes pop up. Yes, for some. I'd say the astute agents who are really going after this and have savvy clients they're representing, which I'd say Loft is in that category, we're seeing the indicators much earlier. And we are starting to see those indicators because people start to get on our website and look at our home value calculator.
Got it.
Google search tendencies start to move. And then, of course, different inquiries and appointments. And, of course, you could have a listing appointment with somebody that isn't selling until June. So we are starting to see some of those preliminary indicators of toying around with the thought of selling. And also, I think more preliminary indicators of people looking to buy, which, of course, if those two things run in tandem, we're not going to see any adjustments in price points or days on market because the increase of supply gets eaten up right away.
Correct.
Or vice versa. So spring market, a little bit more heat, but not much.
It will increase.
I think it's going to increase.
It'll be better.
And I think this year's going to be better than last year.
Agreed.
I do.
Yeah.
Agreed. Well, historically, I mean, it's the worst one in 29 years. So it
has to be.
I mean, statistically, you would think it's going to be better.
Well, and look, I mean, the rates have come down, not drastically, but enough to where we've seen, a little bit more application.
Well, they were trending up, and all the word was they were going to go up, up, up then. Yep. Now it's trending down with the idea of maybe everything continuing to go down.
And that's where I don't like it because you're right. People get locked into down, 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 and that's just not the case. This is going to be an up and down battle. I mean, just yesterday, I know it's not as this being released, but just yesterday from being shot, the Fed said, hey, we're pausing the rates again. We're not lowering them quite yet. We're not hitting those cuts. And I've told you guys, I'm the conspiracy theorist who does not think we're getting 6 cuts this year. I do not think we're getting close to it.
I've said this to you. He hasn't announced any rate cuts yet.
And I don't think they said they have a plan around 6.
Correct.
And and you can vouch for this. For 3 years, I have locked in on what the Fed is doing. They have not stuck to a single plan. Not one. So it's great to say.
Predicting there's going to be 6 rates is different than him actually.
For an entire 12-month span, we don't know what 3 months from now is going to be. We don't know what the inflation reports say. We don't know what the job market's going to look like.
When he says we're doing it, I think that's when it's going to get chaotic. When he actually says we are going to cut rates.
And we can end on this conversation and pick it back up, because that's an
whole
interesting one,
hour,
because the interest rates going lower can actually be of detriment to the people looking for that lower interest rate.
It sure can.
But either way, appreciate you guys. We'll jump back into it next month.